Good day, everyone. Welcome to our confidential report for July 2022. It's been quite an eventful month, as I'm sure you're aware. The big news being that the S&P 500 failed to penetrate resistance at 3,900. Here you can see the chart on the screen. There you can see the resistance level, which is obviously the same as the previous cycle low, or the support level over here. And you can see how the market came back up and tried to penetrate 3,900 and failed. And after that, it fell back sharply. So it first of all failed to penetrate the resistance at 4170, which again you can see is the same as the previous cycle low. It failed to penetrate that, tried several times for several days, and then collapsed. And you can see these exhaustion gaps, which are normal for a market that's really collapsing. There are just no bulls there, nobody to buy. And the market fell down to this low level down here at about 3,666. And then it rallied, as is normal, came back up to the resistance level. What is now a resistance was support, now resistance, and then has fallen back from that resistance level. So what this means is that we are now firmly in a bear trend. We're in bear territory, and you shouldn't argue with that fact. In the market, we've got a favorite saying. It is that the trend is your friend. So don't try and bet against the trend. It's not going to work for you. By the 13th of June, which was a Monday, we had sold out of all our shares in all markets. The S&P 500 had fallen by more than 20% from its high on the 3rd of January, which was 4,796. Our prediction, which was for that this would be a major correction and not a bear trend, and obviously that was wrong. But you have to bear in mind that that prediction was made in November last year, before the Ukraine war had begun. And obviously Ukraine has had a major impact on oil prices and hence on US inflation. So there you can see the chart with the two resistance levels at 4170 and 3,900. We can now draw a very convincing downward trend line here connecting the tops to give us some indication of what's going to happen next. Normally, a bear trend will fall about 50% from its peak. If that happens in this bear trend, then it will take the index down to 2,400 or thereabouts. We believe it will be a slow, kind of dribbling bear trend, which will gradually lose value, interrupted by bursts of misplaced investor optimism. The petrol price in America is now more than $5 a gallon, which really hit home on the July 4th weekend, when most Americans want to get in their car and go and travel. Inflation in America is at a 41-year high of 8.6%. which has forced the Federal Reserve Bank to raise rates aggressively. The last meeting, they raised rates by 75 basis points, or 0.75%. But if you look at it, even with that hike, interest rates in America are still below 2%, and the inflation rate is 8.6%. So there's a long way to go. But if you add into that the quantitative tightening they're doing, quantitative tightening is just the opposite of quantitative easing, then it looks more and more likely that America will fall into a recession in the second half of 2023. Since the 1987 crash and the arrival of Alan Greenspan, as governor of the Federal Reserve Bank, the Monetary Policy Committee has not really allowed recessions in America to last very long. They've used interest rates and quantitative easing on at least 4 occasions as a cushion to prevent consumers in America facing a recession. Of course, the Democrats have got an election in 2024, and it's going, by all indications, it's going to be a very tight-run race, and they clearly would not want to fight that recession into the teeth. They would not want to fight that election into the teeth of a recession, and they will do everything possible to avoid that. The US economy is still far from recession. It's still generating about 500,000 new jobs per month, or just under that level. But I mean, that is not an economy in a recession, not yet. However, predictions are that global growth this year will decline to 2.9%, and you can compare that with last year, or 2021's 5.7% growth. So it's quite a significant decline. And this is mostly because of rising food and fuel prices, together with the COVID-19 lockdowns which have started to happen in China again. Deloitte has been predicting that US inflation will be back at 2% by mid-2023. We think that's nonsense. Inflation will be very difficult to contain. Stock markets, of course, anticipate economic growth by 9 to 12 months usually, and maybe longer. But we expect this decline to continue for at least 2 years, maybe longer than that. So we're talking there about the economic decline, and that economic decline will be to an extent mirrored in the stock markets, although the stock markets will generally be, as we said, 9 months to 12 months ahead. Let's turn our attention now to Ukraine. Obviously, this has now devolved into a grinding sort of stalemate where Russia's making small gains in the Donbass area. The war, of course, is between NATO and Russia. It's been fought out by Ukrainians and on Ukrainian ground, but it is between NATO and Russia. NATO's unity has increased substantially, as well as their preparedness and their size, with the addition of the Scandinavian countries. And of course, NATO is using this war to test out its latest military technologies. And at the same time, it is systematically degrading the Russian economy and the Russian war machine, while at the same time keeping the high moral ground and not committing any of their own troops and not fighting on their own home ground. It seems reasonable to assume that time is not on Russia's side here. The enlarged NATO's resources are virtually limitless. Russia cannot hope to win the war in any meaningful sense, from what we can see. Gains made in the Donbass are coming at an enormous price. We believe that sooner or later Russia will have to sue for peace. They will have to. When they do, Putin is unlikely to survive the political fallout and humiliation. The war is also slowly escalating, with both sides using longer and longer range artillery, and Ukraine now firing rockets into Russia. But we think that the danger is diminishing. The possibility of a Russian attack on another NATO country seems to be fairly remote at this stage. There is, of course, a large impact on markets, with sharply higher oil and food prices, which is generating inflation. Rising world interest rates are causing the bear market to come sooner than we had expected. The American economy is not yet in recession, but will probably be in recession by the middle of next year. The inflation genie is out of the bottle, and it will not be easy to put it back. Okay, turning our attention to South Africa and look just at the political scene. The Zuma camp, of course, is making a concerted effort to dislodge Ramaphosa. The charges laid by Arthur Fraser, a known Zuma supporter. And of course, all of this will reach a crescendo in the November elective conference of the ANC. The radical economic transformation faction is apparently alive and functional, and a serious threat, an impediment to reform within the ANC. We believe that Ramaphosa will survive November. He's survived many other attacks. But we do not believe that the ANC will get a majority in the next election. It's highly likely to lose their majority. So they will drop below 50%, perhaps as low as 40%. And this will force them to compromise with other parties. Parliament will become a force. So instead of just rubber stamping ANC decisions, it will be a battleground where policies are argued and the parties vie with each other to get legislation through that they want. There will be a lot of negotiating, horse trading. The National Prosecuting Authority, of course, has made some significant progress in the last month with various serious arrests. Obviously, we all know that Magashule was forced to step aside. Mkhwebane, the speaker, has been suspended. Obviously, both of those being major Zuma supporters. Two Gupta brothers are in prison and awaiting extradition. So the attack on Ramaphosa could really be seen as a fight back against all these things. Zondo's final report was very critical of Ramaphosa's inaction as deputy president. However, we believe that that inaction was necessary for him to retain his position as deputy president. If he had opposed Jacob Zuma in those early days, he would simply have been dismissed. And the situation today would have been very different because we would have had Zuma or a Zuma supporter in the presidency still. Of course, if we turn our attention to the economy, the big news has been the massive load shedding that we have all faced and are facing still, apparently mainly due to the illegal strike at Eskom, a strike which required Ramaphosa and Pravin Gordhan to step in to arrange a 7% increase for the striking workers. De Ruyter said that Eskom cannot really afford more than 5.5%. So this must sooner or later result in more electricity price hikes. The strike, of course, has been settled, but load shedding will continue for some time. Total outages this year, for the first 6 months of this year, are almost the same as for the whole of 2021. The damage to the economy has been substantial. And we think it's a very bad precedent for politicians to enter an illegal strike and settle it in this way. It creates a very disturbing precedent for future strike action. Of course, inflation in South Africa came in at a shock level of 6.5%, much higher than anybody expected, and of course well above the top of the Reserve Bank's target range. This is because of rising food and fuel prices, mainly again attributable to the Ukraine war. The Monetary Policy Committee raised rates by 0.5% and will raise them at least twice more by 0.5% this year, possibly more than that. We now expect inflation to peak at over 8% here in South Africa. And of course, the Monetary Policy Committee is required to keep interest rates, real interest rates, positive in order to continue attracting foreign funds. The next meeting of the MPC is on the 21st of July, so you can look forward to another 0.5% hike in interest rates at that point. Petrol prices, of course, have gone through the roof, now at about 27 Rand a litre here in Gauteng, as the subsidy is phased out. The producer price index rose by 14.7% in May, and it's risen above 10% per month for the last 6 months. That, of course, will ultimately be reflected in the CPI as producers pass on their prices to retailers. Basic foodstuffs rose by 13.6% over the year, which obviously impacts directly on poor families. When you combine that with the fuel costs, the result is likely to be more protest action. Maize feed prices have gone up 20%, and chicken prices have risen 17%. Chicken, of course, is South Africa's basic protein, so those rises in prices will be badly felt. If we look at growth, GDP in the first quarter grew by 1.9%, which was well above most economists' predictions of around 1.2%. And it's also above the 1.4% that we had of growth in the previous quarter, mainly due to manufacturing. The Natal floods, of course, did damage manufacturing, but even so, they managed to grow that area quite strongly. The ABSA Producer Management Index rose to 54.8, sharply up from April's 50.7. Mining, of course, had a very bad month in April with the holidays, the strike at Sibanye gold mines, and obviously also load shedding. Output was down 15% compared with a 3.2% increase in March month. Tax revenues in this country are heavily dependent on the mining industry. The trade surplus this year to May so far has been 106 billion, and if you compare that to the same month last year, it was 200 billion last year. So you can see the commodity boom is starting to recede and wane. Unemployment improved slightly in the first quarter to 34.5% from the previous quarter's 35.3%. We are not really convinced by this number, although undoubtedly there was a slight improvement in the first quarter. At the moment, the main impediment to growth is load shedding. Letsetsa Kanyago says the economy will weaken as commodity prices weaken. The world economy is heading into a recession, which means a lower demand for commodities. Retail sales in April posted a surprising 3.4% gain, somewhat higher than expected. You mustn't forget that consumer spending makes up 2/3 of gross domestic product, so it's a major factor in determining the level of growth in the economy. All right, let's look at a few other factors in the economy. Meridian Economics has shown that load shedding could have been completely avoided if there had been no interruption of the independent power producer program. This obviously is a severe indictment on Gwede Mantashe, the Minister of Minerals and Energy, who appears to be a huge impediment to the recovery of the South African economy. So we find that to be really inexcusable, that he deliberately interfered with that independent power producer program, and that had he not done that, we would not be facing the load shedding that we're facing now. Of course, we had a group of unhappy truck drivers who held South Africa to ransom by blocking the N3 highway. The knock-on costs of this illegal action are huge, and of course it shows a lack of leadership once again. South Africa cannot afford to allow people to do things which are illegal and which damage the economy in this way, to hold us to ransom. Statistics SA says that 60% of households in the Free State are dependent on government grants for most of their income. 63% in Limpopo and 66% in Mpumalanga. A diminishing tax base is paying for a rising number of poor people. So that is not a recipe for success. Too many people are unemployed, too many people are dependent on these government grants, and the tax base is shrinking. Foreign domestic investment increased to 27.2 billion in the first quarter of this year, up from the previous quarter's 22.7. And obviously this is attracted here by the high real rates of interest, and this has had a big impact on FDI. South African commodity producers have also benefited to some extent from the war in Ukraine, which has kept prices high. All right, let's take a look at the rand. So I just want to quickly take a look at that. Just get the chart on the screen here. Okay, so the chart that I've got for you is fairly simple. You can see that the rand was strengthening until about the middle of April, and then began to weaken once the huge size of the American inflation problem became more and more apparent. That seemed to have been largely discounted by the middle of May, and the strengthening pattern resumed, only to be dislodged again by the shift in sentiment as the US markets went into a bear trend. So when we're in a bear trend, there's a move towards risk off. A move towards risk off from risk on. So the sentiment amongst international investors shifted rapidly to risk off, which means that they withdrew money from emerging markets like South Africa and took their money and put it into US Treasury bills and so forth, safe investments. The rand, of course, is one of the most heavily traded of the emerging market currencies, so it feels the full impact of swings between risk on and risk off. The bear trend on international markets has definitely had an impact on the rand, and it continues to have an impact on the rand. The rand this morning was at about 16 Rand 70 to the US dollar. So this is impacting on all emerging economies and currencies. Okay, so our Monetary Policy Committee has been increasing interest rates steadily, and we expect that to continue. We do not expect inflation to go crazy here, but it is going to rise further. If we look at commodity prices, I want to just go to the Brent, the price of oil, because this has become very significant. It is a major component in inflation in South Africa and worldwide, particularly in the US. So I'm just going to put a longer chart on the screen here and bring in some data back to the slump in oil prices which occurred because of COVID-19, which you see here on the left-hand side of your screen. You can see that oil has been rising between two channel lines, and that the Ukraine crisis pushed it above the top channel line, but it has now fallen back quite heavily last night to around just over $100 a barrel, probably because the general perception is that the world economy is moving towards a recession, and in a recession the demand for oil obviously drops off. We believe that oil will, however, remain high and probably continue to have a negative effect on inflation rates around the world. And that, of course, will result in a continuous pattern of rate hikes amongst various central banks. In the South African mining sector, South African taxes have soared because of the boom in commodities. Despite this, there is a backlog of 3,500 mining license applications. The Ministry of Mineral and Energy Affairs has managed to do about 1,000, bringing this number down, but about 80% of those responses apparently have mistakes and omissions and have had to be sent back to the ministry to be reworked. Just to give you an idea of the impact of this, Australia and Canada get about $2 billion US dollars for mining investment every year. This compares with South Africa, which gets less than 10% of that, mainly because of government inefficiency. And while we're talking about inefficiency, we need to talk about the bottlenecks in Transnet. Coal exports have fallen 20% from 2017, but the price of coal has tripled. So we're in an extraordinary situation here where the price of one of our leading commodities has tripled and we're exporting 20% less than we did 5 years ago. Obviously, it's also impacted on the exports of chrome, manganese, iron, and other minerals. South Africa is simply not capitalizing on the boom in commodity prices, and that boom appears to be almost over now. All right, if we just look at power now, under some general points here, Andries de Ruyter, the CEO of Eskom, has arranged for 18 independent power producers to lease 400 hectares of land, which is located near to power stations, to coal-fired power stations. On that land, they are required to build renewable energy facilities, both wind and solar, but mostly solar. Each one of them will produce 100 megawatts of power, so the 18 IPPs will produce 1.8 gigawatts, and this will obviously have a major impact on the grid. Because these pieces of land are located close to existing power stations, they can easily be connected to the grid and give us additional power. So this is a major step forward. Eskom apparently has about 36,000 hectares of land which could be used for this purpose. So we've only done 400 hectares so far. There's a long way to go, and Andries de Ruyter is very keen on getting this program moving so that we can switch across to renewables and away from coal. Eskom has decided to retire the Komati power station. This is the first major power station to be retired. That power station produces about 1,000 megawatts and employs about 250 people who will obviously be relocated to other parts of Eskom as part of the just transition. So that's some information about the power situation. I'd like to just talk also now a little bit about Bitcoin because it's been quite dramatic. Before the correction on world markets, it was generally suggested that Bitcoin would offer you some kind of hedge against the weakness in equity markets. That has not proved to be true. In other words, people were saying that Bitcoin was kind of like gold, that it would benefit when people move their money out of equities as a result of the bear trend. But as you can see from this chart here, Bitcoin flourished in 2021, but there's a support level around 29,000, and it has now come back. It took quite a while to break down through that support level, but once it did, You can again see there an exhaustion gap, and the Bitcoin price is now down at below $20,000 per coin. And our advice on Bitcoin remains as it has always been. If you have them, sell them. If you don't have them, don't buy them. Zimbabwe is becoming a problem in the African continent. Inflation there has reached 200%. The government is obviously printing money to pay its bills. The currency will most probably collapse again, as it did under Robert Mugabe. The government has once again been forced to allow businesses and consumers to use the US dollar and the rand as alternative currencies. And of course, this will result in further economic hardship in our northern neighbor, and that will in turn result in more illegal immigrants coming into South Africa. So that's something to just keep in the back of your mind. All right, let's look at some companies now. First of all, new listings. There are two that I want to just talk about briefly. The first one is CA Sales. CA Sales has been listed in Botswana and Cape Town. It's involved in warehousing, distribution, and point of sale, mostly for fast-moving consumer goods. It's quite a profitable company, made 390 million profit off a turnover of about 11.5 billion. It's listed on the JSE on the 27th of June. On that first day of trade, there were 34 deals, which started at 505 cents per share and ended up at 745 cents per share. It's now trading at 1,430 cents. So obviously, the people who listed this company left a huge amount of value on the table for investors. Brait is looking to separately list its subsidiary Premier Foods in order to raise about 2 billion rand so that they can use that to pay down debt. Premier Foods is a very well-known food company in South Africa with brands like Iwisa, the maize meal, Snowflake, and Blue Ribbon. The balance of Premier, once the listing has been done, will be unbundled into Brait shareholders' hands. So that will be another listing that comes onto the market. Looking at various shares, Omnia. This is a company that we've liked for quite a long time. It's obviously a diversified chemical company. I just want to say that it produces chemicals for the agricultural industry, for the mining industry, explosives, of course, and also for industry generally. In its results for the 6 months to the 30th of September 2021, headline earnings per share more than doubled. And in a trading statement for the year to the 31st of March 2022, headline earnings per share are expected to be up between 70 and 90%. We drew your attention to the fact that this share had broken up through its 200-day moving average on the 1st of June 2020. At that point, it was trading for 2,747 cents per share, and it's now trading at 7,061 cents per share. So it's gone up 157% over the 2 years since we made that recommendation. But as you can see from a cyclical perspective, it made a cycle high up here at around 83, 86 Rand, somewhere in this vicinity, and it's fallen back towards a new cycle low. So to us, this share is looking quite cheap. It's one for you to bear in mind. The next share I want to look at is Signia. Signia is a specialist financial services group. It's South Africa's largest provider of exchange-traded funds. In its results for the 6 months to the 31st of March, I'll just put a bit more data on the screen here so that you can get a picture. This company produced headline earnings per share up 23%. Assets under management rose by 6.1% to 295.3 billion. The share is now trading on a PE of 9.9 with a dividend yield of 6.8. And technically it's in an upward trend. It looks like good value. It reminds me actually of Coronation, which I purchased in January of 2012. I can just show you that chart. It's quite interesting. Not that I'm saying this share is exactly the same, but it is similar. It's also got a very high dividend yield in an asset management company. So this is Coronation, yeah, and you can see I've marked it on the chart. We bought the share originally over here on the 9th of January 2012, and it was then trading for 23.20 cents. It peaked at 115 in December 2014, and we sold out over here for 90 Rand a share in May of 2015. So we made a really nice profit on that share. What I'm trying to say is that the reason we bought in over here is because at this point the share was trading on a dividend yield of around 7%. So it was about 7%, and as you saw just now, Signia is trading on a dividend yield close to that at about 6.8%. Anyway, it's a share for you to look at and to consider further. The next share that I want to talk about is Storage. We've talked about this share very, very often. It's obviously a real estate investment trust and one of the best ones on the JSE. We really like this company. Sorry, I went to the wrong place there. Let's just put about 2 years data or 5 years data on the screen. There you can see since COVID-19, the share has been in a steady upward trend. This company has got investments both in South Africa and the UK, about 60% in South Africa, 40% in the UK. It has 74 properties, and in total they're worth about 8 billion or 8.5 billion. In the results for the year to the 31st of March 2022, rental income was up 15% with an 88.1% occupancy. The loan to value is what's impressive. It's only 27.9%, so the company has a very strong balance sheet, and as you can see, it's technically in a strong upward trend. We like this share. We think it's close to that trend line, and it should bounce off these levels. So that's Storage. And then I just want to talk a little bit about Process, because last month in the confidential report, we suggested that one of the ways to benefit from the situation that we were facing was to buy Process shares. This share fell from a high of 1,937 Rand per share in February 2021. Finally found some support here, as you can see, at around 690 Rand per share. At these levels, we thought it was pretty cheap, and in the confidential report on the 1st of June 2022, we advised that this would be a share that you should look at and could buy. Since then, the share has moved up very strongly. It's closed last night at 1,226.74, so that's a gain of 33.7% in just 1 month. And obviously you can see here that this is confirmed by the break up through the 65-day exponentially smooth moving average. Okay, folks, well, that's about all the shares I have for you today. Just a warning, however, that obviously since the 13th of June, we have been in a bear trend. This is a primary bear trend. The probability of choosing a winner in a bear trend is not as good as the probability of choosing a loser. Even if you find a share which is very good on its fundamentals, looks wonderful, great profits, all that sort of thing, it can still fall because it can get dragged down by the market as a whole. So if you do choose to buy into shares at a time like this, when we're in a bear trend, know that the probabilities of being successful are against you. And make sure that you have a very strict stop-loss strategy in place and that you adhere to it. Thank you very much for listening to me today. I hope that you found something of value here, and I look forward to talking to you again on the first Wednesday of next month. Thank you.